What's up, guys? I'm Nobody Special. And with commodity prices being in this rip-roaring rally that they've been on for the last couple weeks, you can understand why a lot of people might be looking into mining stocks right now. As these metal prices go up, surely the people who produce the metals would be seeing windfall profits. Not so fast. When you look at what's going on in the economy and where the breakdowns in the supply chain are, it's not so easy as just pouring money into mining stocks right now, and you need to be careful which miners you choose. Ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And I get a lot of questions about mining stocks from viewers and a lot of comments saying, have you seen this mining stock? Or with metals prices going up like they are right now, at least in the base metals, surely the mining stocks are where you want to be right now. And in some cases, that may be true, but you have to look a lot closer at what's going on in the economy and where the breakdowns are, because it's not as simple as just pouring money into mining stocks right now. And if you're not careful, you could end up getting burned. Now, before we get too far into this, I have to ask folks, could you please give me a big thumbs up, subscribe to my channel, hit that notification bell. It really helps me out, and I would be forever in your debt. And with that, it is that time to shrink my big fat melon of a head and get into this. And you will see in some of these articles that it is not all rosy. Everything is not great in the mining space. First, let's talk about this story yesterday. The London Metals Exchange almost ran out of copper. Inventories of the metal have fallen this month to their lowest level in 47 years. The London Metal Exchange took action to calm turmoil in the copper market late on Tuesday by introducing temporary limits on some prices after a plunge in stocks of the metal in its warehouses disrupted trading. The LME said it would adjust its rules requiring large holders of the metal to lend it back to the exchange. It also said it would bring in a limit on backwardation, a scenario whereby spot contracts trade at a premium to futures contracts, indicating that the market is undersupplied. And I'd also mention something down here I saw. The LME said on Tuesday that it will allow those with short positions in copper to delay delivery of the metal to settle their positions. All right, so for those Wall Street silver folks who watch my channel, and we've been talking about smashing the COMEX all year, keep an eye on what they do here when they run low on metals, because maybe their first few moves might be the same if things go wrong in silver for them. You see that they're putting in price controls, they're giving special privileges to the shorts to give them more time to cover, so that might be a preview of what's to come if the COMEX ever does fail, like a lot of the folks in Wall Street silver hope it will. But the point of this article and drawing to this is that the copper market is very tight right now, but I need to emphasize that is the refined copper market, right? This is copper futures trading. They're not talking about copper ore that just came out of the dirt. And now, if you look, getting into this article from today, copper falls as LME squeeze begins to fade, and it looks like that story was fun while it lasted. Benchmark LME copper was down 2.6% at $9,926 a ton, and the premium for cash copper over a 3-month contract had reduced to $267 a ton. So the backwardation, it's still deep in backwardation, but not as deep as it was. It seems like the panic in the copper market has somewhat settled down. And I just want to draw attention to down here to this paragraph. We're seeing a loosening in the copper market, he said, pointing to rising mine and scrap supply and slowing demand in China, which is suffering power shortages and weakening economic growth. And this is what you got to be careful of right now with these mining stocks, folks. Slowing demand in China and power shortages, okay? That is the meat and potatoes of this story, okay? And I did this video a couple of days ago about how I think the situation with China Evergrande and the collapse of the Chinese housing market is going to eventually lead to a reduction in the silver supply, because it's going to hit the copper and the zinc miners particularly hard. And I want to focus on the difficulty in the miners, because I think we're already starting to see a little bit of that. Now, first of all, why would the miners be having trouble even though we've got these sky-high metal prices? Well, you have to remember the miners don't sell finished product. The miners sell dirt. They sell their ore, right? They dig it out of the mine. They have to send it to a refiner, to a smelter, where it gets heated to these ridiculously high temperatures, consuming lots of power, melted down, purified. Then it gets sold into the futures market. Okay, but right now, all of these refiners and these smelters are really struggling. We did a video a few days ago about how a zinc smelter in Europe was being forced to shut down. because these industrial facilities require huge amounts of energy, and we're in an energy crunch right now. So as these energy prices go up, these smelters and refiners are getting less profitable. So they're shutting down because it's not profitable to operate, or in China, they're being ordered to shut down by the central government to save power. Now, this is not good for miners because remember, these smelters and refiners, these are the customers of the miners. The miners sell their ore to the smelters, and then the smelters refine and sell the finished product to the market. So if the smelters are shutting down, if the refiners are shutting down, this means there's no market for this ore to be sold into. So if you're a miner, this actually looks like a reduction in demand as far as you're concerned, because there's all the demand in the world for the finished product further downstream in the supply chain. But the demand you're worried about is the demand at the smelter. And right now he's shutting down because he's got no power. So just because these metal prices are skyrocketing right now does not mean the miners are automatically becoming more profitable. You need to pay close attention to these mining stocks you're getting into. Find out where the mines are located. Is their labor supply secure? Because labor prices are going through the roof. Is their energy source secure? Because there's energy shortages all over the world. And where do they sell their ore to? If they're selling it to smelters in China, guess what, folks? That ore is going to start piling up at the docks, which means that price that the miner gets for his product is about to go down. And shrinking me again, we're starting to see that. Here's a couple of articles I found. Miners pull London's FTSE 100 lower, Unilever gains. China property sector woes weigh on mining stocks. This is dated today. London's FTSE 100 index fell on Thursday as miners dropped due to rising troubles in China's property sector and investors fretted about rate hike prospects. Scrolling down a little bit here, the blue chip FTSE 100 index ended 0.5% lower, with miners sliding 3.5% on fresh worries about the heavily indebted property developer China Evergrande Group. Anglo American was among the worst performers on the commodity-heavy FTSE 100 index, falling 2.8%, despite reporting a 2% rise in third quarter overall production. Other miners, Rio Tinto, BHP Group, and Glencore, were down between 2.4 and 4.2%. And it looks like the same story over in Australia, as we have this article in Reuters, again dated today. Australian shares almost flat as Evergrande worries weigh on miners. Australian shares closed little changed on Thursday as the lifting of restrictions in Melbourne later in the night helped investor sentiment and offset worries about China Evergrande Group's potential debt default. Scrolling down here, we say the metals and mining sector, which relies considerably on exports to China, took the biggest hit on Evergrande news, falling 0.25% despite strong iron ore and metal prices. So what they're saying in these articles is even though the prices are strong right now, the miners are worried that the power situation in China and the eventual reduction in demand from the collapse of the Chinese housing market is all bad news for base metal miners. So again, you must be careful with these mining stocks that you're getting into. If they get a large percentage of their revenue from things like copper, from zinc, from iron ore, then you need to be careful because they're absolutely vulnerable to this China Evergrande story. And regardless of what the prices for those refined metals are doing right now, they still have the issue of the refiners and the smelters being shut down by these power curbs. And that means the raw ore is going to start piling up at the dock as they have nowhere to ship it to. And that's going to hurt the prices that the miners are getting for their ore. And shrink me again, we see this all summed up nicely in this final article here. Let's make sure you guys can see me. Shrink me further. Energy crisis bottlenecks blunt metal rally windfall for miners. Let's zoom in a little bit, make Mrs. Special happy. Soaring metal prices should mean surging profits for mining companies, but they are the result of energy shortages and logistics bottlenecks that are also pushing up costs for producers. The latest leg up in copper and zinc futures is coming on the heels of a global energy crunch that's beginning to disrupt the smelters that many miners depend on to process what they pull out of the ground. That's great for refined metal prices, but suggests further hikes in smelting and refining fees already at the highest levels since earlier in the pandemic. For companies like Hong Kong-listed MMG that ship mainly semi-processed metal called concentrates, those higher treatment and fees blunt the boon from elevated metal prices. On the other hand, producers with plenty of in-house smelting capacity, like Chile's Codelco and Poland's KGHM, something I can't pronounce, are less vulnerable. And there's something else I wanted to mention here. Another impact from logistical disruptions and inflation is a global squeeze on sulfuric acid used in some mining operations, with prices at their highest levels since 2013. And the article concludes with, to be sure, the extent of the metal rally probably more than offsets those costs and increases for most miners, but the industry will be paying close attention to energy markets over the coming months for sign of further tightening. Now, this article focused exclusively on supply chain disruptions and on the power prices. It did not mention the pending falling off a cliff in demand coming from the collapse of the Chinese construction industry. And as we saw from a video I did earlier today, there was a 97% reduction in sales for China Evergrande. That housing market has frozen and ground to a standstill. Nothing is moving. So long story short, folks, you need to be careful about the miners that you're getting into. You need to do your due diligence and look at the particulars of whatever company you're looking at. Find out where they are, find out where they ship to, what metals they're in, how secure is their smelters, do they have in-house smelting operations, what are their labor prices doing, what are their energy costs doing, because remember, your miners use a lot of energy. So you need to be more careful. It's not just about pouring money into ETFs that track mining stocks, because this is not a situation where all miners thrive. This is a situation where a lot of miners may actually go under as they have nowhere to sell their product. Anyways, guys, that's all I got for you in this one. I hope you enjoyed this video. I want to thank you for your time. Don't forget to hit that thumbs up and subscribe to my channel. Hit that notification bell. It really helps me out. I'd be forever in your debt. Until next time, live small and dream big.